The 9 mistakes investors most commonly make. All traders and investors make mistakes, otherwise we'd all be millionaires. The trick is figuring out what our investing mistakes are and then trying to avoid them. 1. Hindsight error. Because you can see the past clearly, you think you have a similar ability to tell the future. Hindsight error is common at the moment because many people are convinced they saw the crash coming in 2007. In reality, they may have thought a crash was possible, but they also thought the market might continue to zoom upward. Now, investors are convinced they actually saw the problem in 2007 but just didn't act on it, so they believe wrongly that they can act correctly today. 2. Unrealistic optimism. This is loosely related to overconfidence. Psychological studies have shown that when you ask people if they think they have the ability to pick stocks that will have above average returns, men tend to say yes more often than women. It's not because men are so smart, it's because men are unrealistically optimistic about their abilities. When you are unreasonably optimistic in the stock market, you're just readying yourself for an accident. 3. Extrapolation errors. People expect that trends that existed in the recent past will continue in the future. For example, the fact that gold has gone up for the last 10 years has led many to believe it will always go up. But a study of a longer period, going back to 1971, when President Richard Nixon ended the gold standard, shows that gold hit a high of $850 an ounce in 1980, but was selling for $345 as long as 10 years later. 4. Framing errors. Investors make framing errors when they see a CEO on TV talking about his stock. If it sounds good and you buy that stock, that's a framing error. Instead, you should be asking yourself, who else is watching this program? And what do I know that is uniquely mine? The answer is nothing. 5. Availability errors. This refers to what information is available in your memory. Investors are often lulled into this error by investment companies. When you see an advertisement for a fund, it's almost invariably for one that has a 4 or 5-star rating from Morningstar. That way, the 1 and 2-star funds with lackluster results aren't available in your memory. You say to yourself, there's a 90% chance I will be a winner. Instead, look at results of entire fund families, including the losers, not just the winning funds for a particular period. 6. Confirmation errors. Investors tend to look for information that confirms their hypothesis, but they disregard evidence that contradicts it. Gold bugs, for example, constantly reminds us that gold is a good hedge against inflation and a declining dollar. But when confronted with the evidence that gold actually fell price for an entire decade, they dismiss that as a different era. 7. Anger. This is an emotion we all know. In investing, you try to get even with the market. If you feel angry, it's better to wait 10 days before buying or selling, or you'll regret it later on. 8. Fear. The other side of exuberance. When you're afraid, everything looks like a threat. Lots of investors are still afraid because of the market crash 2 years ago. Risk and return go together. So if you think the market is risky today, then you should also think the market has a good potential for high returns. 9. Affinity of groups, also known as herding. You hear from your pediatrician that he's buying gold, so you think you should too. But what do these people really know? What is the analysis based on? Some herds are worth joining and some aren't. Buying internet stocks in 1999 or houses in 2005 based on what everyone else was doing was a horrible mistake.